Hi guys. So in this week's Financial Times, we're looking at the specification in terms of financial markets and financial institutions. And this is a great article from the FT, whereby we can start to think about what went on during the financial crash, what happened, what were the causes, and what actions have been taken by central banks, not only in the UK, but globally in response to that. So we're looking at this article, UK government to sell next £1 billion stake in the NatWest. And that is, of course, because during the financial crash, in order to prevent the banking sector from basically going bust, the government had to step in and offer what was referred to at the time as a sovereign guarantee, thereby really moving to the point where the taxpayers were taking enormous stakes in these what were privately owned banks, helping to prop them up. And ever since 2008, the central bank has then been, the government has then been selling off their holdings in the banks, obviously with the intention that in the longer term, they will return them to full private ownership. Unfortunately, if you read this article, you'll see that the sell-off here, this £1 billion stake sell-off, again, this represents a loss considering what the government invested at the time during the financial crash. And so the taxpayers really bearing the burden of this loss. Before I start on the questions, I'd like to point you to some reading, which would be this great book by Mervyn King. Get it in shot there, The End of Alchemy. It's a fantastic book. And a lot of what is mentioned here is kind of elaborated on by Sir Mervyn within this book, former governor of the Bank of England, of course. So let's have a look at each of the questions. The article refers to the US subprime mortgage market. Explain what's meant by a subprime mortgage. So subprime mortgages, very simply, mean that there is a high degree of probability and a very high likelihood that the borrowers will default on their mortgage. In other words, they will not be able to return the borrowings to the bank. And the subprime mortgage market began in the USA, emanated in the USA, and subprime means that you've got basically a loan book issued by the bank and banks, and they very cleverly disguise the contents of that loan book by making potential buyers of the loan book think that it's all A1 mortgage, A1 loans. In other words, that the people who are within that loan book, they're very, very creditworthy. They will never default on a loan. And therefore, if I sell you this loan book, and why would you want to buy the loan book? You would want to buy it from me because you could earn a return on it, because, of course, loans generate interest. But very cleverly, what happened in the subprime mortgage market was that the loans of, say, Beverly Hills and Miami, which, of course, you would consider to be very kind of affluent, wealthy areas of the United States of America, and therefore the borrower is very unlikely to default on their loans. Well, their loans were bundled up alongside loans from people in Detroit. Now, Detroit, of course, car industry, very kind of heavy manufacturing in Detroit, and people there suffering from the decline of those industries and consequently a lot less able to pay back loans. But that didn't prevent the loans from being issued. And so what happened was that the banks, they bundled all these loans together, Beverly Hills, Miami, and Detroit. But rather than saying, oh, we've got some Detroit in here, they said, well, all of the people within this loan book, they're all very creditworthy. Don't worry about buying this loan book from us. They will never default. And of course, what happened? Well, they did actually default. Now, the Northeast equivalent would be to say something along the lines of, well, Darras Hall and Jesmondo, affluent areas, let's bundle that up with maybe a less affluent area such as Gateshead and label that loan book as Darras Hall. Let's then sell it on. And of course, you buy it. There's an asymmetry of information here. So the person who's bundled up the loan sells it on. They know full information about it, but the person buying it doesn't. And of course, asymmetry of information, as you know, is a great source of market failure within an economy. And that really is the subprime market. So people were almost tricked into buying loan books, which they thought were A1 credit, but actually it was a mixture of A1, but down to sort of D minus credit as well. Okay, question 2. The 2008 financial crash has its origins in the USA, however, it proved highly contagious. Explain the meaning of the term systemic risk. Okay, really important this, particularly as we move into the macro section of the course where we look at globalization, the interconnectedness of the world. And because of that, all of the gains that come with globalization through lowering of barriers to trade, improved technology, etc., all flattening of the earth, as they call it, all of these benefits, of course, there are downsides. And one of the downsides is that markets are so heavily intertwined and interconnected that whenever you get a crisis in one part of the globe, it very quickly spreads to other areas. And this is what we mean by this notion of systemic risk. So it's very often associated nowadays with kind of financial markets and financial market risk. Number 3, bit business studies-ish, this question. Limited liability in a bank means that owners have an incentive to take risks. I actually quoted that directly from Sir Mervyn's book. Explain what's meant by moral hazard. First thing to say is, of course, that moral hazard is something that we've looked at in market failure, commonly associated with insurance markets, and it's a behavioral side of economics whereby your behavior is changed because of the cover that's provided by insurance. So lots of you learning to drive at the moment, I know. If you weren't insured, you'd be super careful in your car, even more careful than you are at the moment, because if you crash said car, you would have to foot the bill to recover it. Alternatively, if you've got insurance and you are unfortunate enough to have an accident and a prang, then you know that you only have to pay the excess on the policy and the insurance company will pick up the rest. So you probably don't drive quite as carefully as you might otherwise do if you didn't carry the insurance. Similarly, in the banking sector, because bankers who had the potential to earn enormous returns, they weren't doing that with their own money, they were doing that with somebody else's money. They're doing that with depositors' money, and savers' money, and investors' money. And because it's not their own money, that then alters their behavior. And kind of to add to that snowballing effect is this notion of limited liability. Now, limited liability, kind of a business studies term, but it means that you're not fully liable for any losses which may be incurred. So you're only liable for a limited, there is the name, for a limited sum. And consequently, bankers were encouraged to take excessive risks because they knew that ultimately, should things go absolutely pear-shaped, and the bank goes bust, well, who bailed them out in the end? The government bailed them out, and they've got that sort of fallback, and as a consequence, their behaviour is altered. So that's that notion of moral hazard. Number 4, the bank suffered a devastating decline, the bank run notion. Very often quoted, of course, is that Christmas film, whose name escapes me, where we see the idea of a bank run. But the important thing here is that banks are privately owned, shareholder owned, profit-seeking enterprises. Loans earn them money, and when you deposit your cash in the bank as savings, that costs the bank money. So obviously banks want to max out on the loans, and they want to hold as little cash deposits as possible. Well, that's all very well as long as things are kind of carrying on. We don't have any big shocks to the economic system and the financial sector. But when we do have a big financial shock, you then, as an individual, you probably would rather have the hard cash in your hand just to know that you have your money because you're worried that the bank might go bust. Therefore, you get along to the bank and you try to withdraw your money. But because the banks have most of the monies out on loan, if you're at the front of the queue, you might get your money back. But if you're number 1,000 in the queue, you probably won't because they just don't have it. It's because of this relationship between the cash deposits and the monies out on loans called the cash deposit ratio. And finally, lessons have been learned. Of course, lessons have been learned. We've been lucky enough to have a number of representatives from the Bank of England, both here in the Northeast and London, come to college and to talk about this. Counter-cyclical capital buffers, a bit of a tongue twister, I know, but there have been all sorts of measures put in place, the so-called stress tests, so that should there be another financial crash, the banks will be much more resilient. And there's a link there to a video on the Bank of England website, which you can have a look at. Okay, ladies and gents, hope that's useful. And if there's anything that you don't have in your FT answers, then I do want you to go back and to include this. Goodbye.